Welcome to another 3 Steps to Startup podcast brought to you by Tech Connect West Virginia, Innova Commercialization Group, and the West Virginia Jobs Investment Trust. This is Jeremy Turner from Epic Mission, where we are guiding the heroes of change, and I'll be your host. This podcast is part of the 3 Steps to Startup initiative. The goal of 3 Steps is to provide early stage entrepreneurs with critical assistance and structured guidance for innovation commercialization from ideation to product launch and market entry. 3 Steps to Startup is made possible by support from the Appalachian Regional Commission and the Claude Worthington Benedum Foundation. Today's podcast is one in a series in which listeners will have an opportunity to drop in on conversations with industry veterans and subject matter experts who offer deep insights and actionable intelligence to help entrepreneurs launch and grow their ventures. Today, we're picking up on a conversation we started previously with Scott Ewing, co-founder and principal business analyst in the Appalachian Investors Alliance, or AIA. AIA is a nonprofit that facilitates greater access to angel and venture capital for entrepreneurs throughout our region. Scott, once again, it's nice to have you with us.
Thank you, Jeremy.
Scott, in our last podcast, we left unanswered a question about how investors must determine an entrepreneur's true intent. Does the entrepreneur intend to build a lifestyle company or a growth business? Most entrepreneurs claim they want to grow their business towards some form of exit or acquisition. After looking at over 500 investment deals in the past few years, you're convinced that what entrepreneurs pitch and may honestly believe can be very different from what actually happens when they carry out their plans.
Yeah, sometimes events follow the business plan, assuming there was a written plan. Many entrepreneurs have been led to think that so long as they're willing to do whatever it takes, things as they come up, they can offer up their idea and make it work out in the end. Perhaps they've heard the old Marine Corps mantra, adapt, improvise, and overcome, which is fine, except what Marines are talking about is managing execution risk. We like to separate the question of execution risk from that of planning risk.
Okay, so execution risk versus planning risk. Can you unpack that for our audience, please?
Sure. Execution risk involves failure to carry out a plan. Once an event or activity gets started, there are always factors that can cause failure. The economy, people, a virus, changes in taste, tough competition, lots of things can create problems that need to be worked through. To manage execution risk requires ensuring that emergent problems don't bring down the entire operation.
All right, Scott, so what about planning risk?
Planning risk is what happens when you don't take into account those problems that can occur in the execution. No plan is perfect, but many plans are useful. As investors, it's hard for us to predict how well or poorly an entrepreneur or team will be able to adapt to changes and overcome challenges. A reason for investors to get to know an entrepreneur before making an investment is to gain a sense not only for how committed the entrepreneur is, but how nimble-minded and open to advice he or she is. Can the entrepreneur think on her feet? Does she understand her business? And can she make quick, decisive corrections? That all has to do with execution risk. We assess planning risk by looking at the company's business plan, their financial pro forma, their budget, and their capital plan.
Okay, so Scott, are you looking for errors and omissions, unrealistic projections, questionable expenses? What is it that suggests there's planning risk in a deal?
Just as with execution risk, there's always some element of risk that goes with planning. Simple mistakes can be expected and investors can question those. But we'll look very hard at underlying financial assumptions, technical development timelines, and evidence for customer demand. If in some element of the business plan, whether it's the selling strategy, the plan to raise capital, assertions about customer prospects, if in some element we find that the entrepreneur either avoids or hasn't taken into consideration issues that are foundational to just about any business's success, then challenges from investors are likely to become more direct.
All right, so just to recap, execution risk happens after a business is launched. Planning risk comes from an entrepreneur's failure to do adequate homework before starting the business. Your investors try to distinguish between the two before they make investments in a startup. Execution risks can sometimes be overcome through hard work and making a pivot. Planning risks are faults that become embedded in the business from conception and lie in wait once the business starts to operate.
That's well said, Jeremy. The more faults that can be uncovered in the planning stage, the fewer the problems that could become manifest after the entrepreneur has received investors' capital.
Now, Scott, tie the idea of planning versus execution risk to the question at the start of today's podcast: how investors must determine an entrepreneur's true intent. Does the entrepreneur intend to build a lifestyle company or a growth business?
Before I do, let me make clear that our investors will respect solid entrepreneurs and small business owners, irrespective of whether they operate a high growth technology startup or a cash flowing, job creating Main Street lifestyle company. Our investors have funded both types. The important thing is that the entrepreneur understands what sort of business they're building and represents their business objectives clearly and honestly to investors, determines the appropriate plan, and then executes well.
You just said investors have invested in both types, lifestyle and growth companies. It seems entrepreneurs often hear that only tech growth companies can attract investor capital. Are you saying that's not the case?
I can't speak for anyone other than the investors I work with, but we've worked with quality entrepreneurs starting restaurants, hotels, retail companies, and commercial service firms that would generally be categorized as Main Street businesses. We've also invested in advanced materials, software, medical device, and advanced manufacturing companies that were obviously technology growth opportunities. What guides our investment approach is that in every case, the entrepreneur must be able to deliver on a clear business model for returning value to the investors. Entrepreneurs show us through their pre-investment readiness that they can reduce planning risk. Then, leveraging their reputation and experience by doing what they planned after receiving investment, they stand a good chance at managing the execution risk.
Okay, Scott, what are indicators of a lifestyle business as opposed to a growth company, or maybe a lifestyle business mistaking itself to be a growth startup, or a lifestyle business plan versus what you'd expect to see in a high growth business model or plan?
And Jeremy, lifestyle companies grow sales to add more employees or to increase salaries and expenses. It's easy to look at a company's financial model and see how much of what's earned in sales flows through to the bottom line as profit, and how much of the profit remains in the business as owner's equity. If between the gross revenue top line and the net income bottom line, expenses consume most or all of the revenue, the company can't claim to be on a fast growth path. With real lifestyle companies, profit is drained from the company by the owner to fund owner's living or recreational expenses, or to purchase assets such as real estate that are unrelated to the core business. Now, in a growth business, profit is used to organically increase sales and, most importantly, improve profitability. It's not enough for profits to be used to add additional salespeople. Profits must be used in a high growth model to create margin expansion. Ideally, each additional dollar of sales should become cheaper to acquire than the last one. That's what a true growth company does.
Margin expansion. That's a key for attracting investors. A company's historical financial results ought to provide information that gets used to build an accurate pro forma. If a company is a startup and doesn't have a financial history, the assumptions that go into creating the pro forma should be based on doing as much firsthand research as possible, not just looking up a few articles online, but doing interviews with customers, potential suppliers, other business owners, paying for additional market research if that's needed to fill gaps in knowledge. But that needs to be done before creating a financial model. Correct, Scott?
Yeah, spot on. And investors will be able to tell if a deep dive was done to gather the best possible information. Simply looking at the pro forma will generally reveal the amount and quality of work that went into building the financial model. Lots of times we see really complex financial models, sometimes overly complex, to the point where we suspect the pro forma is being used to make it difficult for anyone to actually understand what's going on in the business. A company's pro forma should be clean and easily understood with enough detail to compare what's being promised with the assumptions that went into building the model.
With a pro forma, investors are looking to see that net revenue gets larger over time as a percentage of gross revenue. In other words, the amount of money the company holds onto from sales after paying for the cost of goods increases, and that the amount of net income or profit from the business after paying expenses increases. That's what's meant by margin expansion, right, Scott?
Yeah, it becomes marginally less expensive to produce something for sale, and the company becomes internally more efficient and keeps more of what it earns from sales. Every business should do those things. A growth business must do them.
Scott, a moment ago, you said that investors made deals with growth and Main Street or lifestyle companies. Margin expansion can be difficult for a Main Street business, say a service business that can't cut labor costs or input materials without affecting quality.
Right. You don't want a restaurant to skimp on portions or switch to cheap ingredients. And you don't want to see knowledgeable staff replaced with cut rate labor. When experienced staff in a customer facing business or in customer facing positions are replaced by minimum wage workers or worse, by machines, quality in the customer's experience is likely to drop, driving away formerly loyal customers.
So if a service company, or I'll say a Main Street small business, has a difficult time cutting costs, how can that be an investable business for angel or venture capital?
Well, assuming when we look at the company's financials that we don't see much fat in the expenses, such as expensive vehicle leases, luxury offices, make work jobs for family members, big ticket travel and entertainment costs, that sort of thing. If the business is being run cleanly so we can expect it to stay viable, then working on a deal comes down to structuring the right type of funding terms. I mentioned last time we met that revenue sharing, which sometimes gets called royalty funding, can work with lifestyle type businesses. Investors get their return off the top line rather than off the bottom line, which means that they'll take a small percentage of gross revenue. Then what the entrepreneur likes to pay in salaries or operating expenses isn't the investor's concern. So long as the business stays in business until the investment is paid back.
Scott, what other telltales do investors use to warn them when an entrepreneur pitching growth is likely to wind up running their business more like a lifestyle venture?
Ownership on the capitalization table, who owns what percentage of the business, and control terms in a company's operating agreement can be indicators. It's easy to point to certain billionaire tech founders who seem to maintain dictatorial control forever over their companies. But in my experience, most founders hoping to build a growth startup understand that the skills required to take a novel idea and turn it into a new business are different than the skills needed to expand an established business to the next level. An entrepreneur that never intends to give up absolute control of their business and fights any combination of board of director votes or shareholder rights that could overrule the founder, that entrepreneur may not be building a real growth business. At a minimum, they probably lack self-awareness to know when to pass the baton once a business has grown beyond their competence to run.
Great. Scott, any others?
The company's plan for raising future rounds of capital is always informative. The definition of a growth company is that the company will require outside capital to fuel growth at a rate faster than organic revenue can support. Sales alone for a time won't result in enough net income to grow the business. So the entrepreneur needs to give up some portion of ownership or some claim on revenue to attract outside investment. Investors can help a company get over growth hurdles in a timely manner, but if we see that a company plans to raise successive rounds of capital without achieving the margin expansion we talked about a few minutes ago, if the company's expenses over time increase, but profitability and sustainability doesn't, we suspect that the entrepreneurs aren't really building growth business, but are instead living like employees off investors' infusions of cash. Employee entrepreneurs, we might call them. Where we see these sort of entrepreneurs deluding themselves and possibly investors is in the forward financial projections that look like a proverbial hockey stick. Sales and expenses rise for a while in tandem, and profitability lags. And then suddenly, say in year 4 on the pro forma, profits lift off to an almost magically and continue to grow exponentially, afterward. Nothing, right? Then boom, off to the moon.
Wow. Scott, how about one more?
Okay, if the entrepreneur tells us they only intend to raise one round of outside capital, perhaps a seed stage round, then expects explosive sales growth afterward, and even plans to buy back the outstanding shares from the early investors, that usually isn't the way a genuine high growth opportunity plays out. I want to stress again, there's nothing inherently wrong with an entrepreneurs needing only one round of outside financing to get their business going. It may be that the entrepreneur needs to finance a specific capital expenditure, maybe buy manufacturing equipment, and then afterwards, they'll be able to reach self-sustainment. The company may grow substantially after that, but by the definition I gave, it's not a growth company. That sort of fund once and done opportunity isn't usually associated with fast-growing startups that will expand market share ahead of throwing off enough free cash until the critical number of customers is reached. Growth startups are expected to need 2, 3, maybe more rounds of sequential capital at ever-increasing company valuations. Both company business plans factor in multiple funding rounds. If the company doesn't follow the high-growth capital plan or model, maybe it's not a great equity purchase opportunity for investors, but it could be a very good equipment financing or debt deal, or as I said earlier, revenue sharing deal. That sort of company would have a different, likely slower, but steady business model, one that showed intent not to flash build market share and exit the business quickly, but to establish long-term sustainability. There's nothing to say that a business built for the long haul can't end up one day being sold for millions, even hundreds of millions of dollars. We've seen that happen. The point is, investors can be creative and flexible with startups and small businesses, so long as both the entrepreneur and the investors agree on what the true nature of the business, the appropriate business plan or model, and what's needed to capture the opportunity.
Scott, as always, great stuff, but it looks like we've run out of time for the day. I want to thank you again for being here with us.
Jeremy, I am always pleased to be here, and look forward to chatting again. Always a pleasure.
Excellent. Well, until next time. Well, we have reached the end of this episode of the 3 Steps to Startup podcast, brought to you by Tech Connect West Virginia, Innova Commercialization Group, and the West Virginia Jobs Investment Trust. It's our hope that you, the listener, heard something today that challenged you to think differently and provided the insights you need to take your venture to the next level. To check out additional episodes of the podcast or to learn more about the 3 Steps to Startup initiative, please visit 3stepstostartup.com. Thank you for tuning in, and we will look forward to seeing you next time on the 3 Steps to Startup podcast.